Well, hello. What I'd like to do in this video is introduce you to the project that's going to be required for this quarter. Now, this project is going to have two components to it, an Excel worksheet, which does all the calculations, and then a written report. And I'm going to take you through an outline of this. I have certain interim deliverables to be sure that everybody is on task for the balance of the quarter. But my goal with this, and I'm going to give you basically the answer to the spreadsheet, is to have everybody get the same answer and the difference in anybody's project be just the write-up. I'm going to take you through all of that right now. So what we have here is we have a company, and what they do is they distribute heating oil throughout the Southeast. And so what they do is they're basically a reseller. They buy heating oil and they sell heating oil. And so they make a profit on the sale. And what's happened is they have a lease agreement that's not going to be renewed. So the company has to make a decision as to whether or not to just terminate operations in the area or build new facilities and continue the operations. Now there's we're going to analyze the problem with this, and you have some of the techniques or some of the skills at this point in time to do the analytics. By the end of next week or the week after, you'll have all of the skills, because we haven't covered depreciation and taxes, and that's important in here. So what the company wants to do is they have a hurdle rate. They have a minimum attractive rate of return of 14% on all investments. And what they want to decide is whether or not they should spend $8.5 million to build new facilities. Now, MACRS is a depreciation class. You'll learn about it in the next video. But the new facilities cost $8.5 million to build. They're going to have rent charges of $350,000. Our period of analytics is 20 years. So basically we have 20 years of $350,000. And then what else is in here? I want you to assume that end of year zero is basically January 1st, 2023, December 31st, 2022. So this is a distribution company, and basically they're receiving bunker fuel oil, heating oil, and then they're selling it. So they have a lot of trucks and other vehicles. So the trucks that they currently have at the facility have an estimated market value of $500,000 and a book value of $325,000. That's going to be important if you decide to stop operations. If you don't decide to stop operations, you can continue using these trucks at the new facility, but they're going to need to be replaced. I'll talk about that in a little bit. Also, we need to put new equipment into the facility periodically, primarily computer systems. And so they're going to need to go in every 5 years. The initial outlay for the computer systems are included in the $8.5 million upfront cost, but every 5 years you're going to need to replace those computer systems. That's going to cost $75,000 every 5 years. And again, you'll learn about the depreciation. So that means you're going to have depreciation outlays in year 5, 10, and 15. I think you can assume if you're going to stop operations in year 20, you won't need to make an investment in computers in year 20. You're also going to have to replace some things like pumps, things like that, tanks, halfway through the life of this project, which is 20 years. So you're going to have $1.5 million expenditure on those in year 10. And then this is a trucking business. We're trucking fuel oil, heating oil all over the Southeast. So we're going to have a continuous expenditure for trucks. And that's going to be $175,000 each year. Now, What we're talking about is buying a product and then just reselling it. So we're a distributor. So we're going to be buying 2 million barrels every year, beginning in 2023. And I think you can assume it will occur at the end of 2023 for purposes of the analysis of this project. They're going to, that 2 million barrels is going to increase at 3.5% per year for 6 years, and then it's going to hold constant. And that's just kind of an input assumption item for the start of this project. And so what we're going to be doing is we're going to be marking up this bunker oil. We're paying $85, and we're going to mark it up 4%. So that's what our profit is going to be. That's how we're going to make money in this business. And then we believe that the price of oil is going to increase 1.5% per year over the planning horizon of 20 years. Now, obviously, we've seen what's happened in the oil industry. And when I talk about sensitivity analysis, this price of $85 is going to be something we're going to want to analyze. I haven't discussed taxes yet, but what I'm giving you is an assumed tax rate of 30%. But again, that number can change depending upon the political situation. So these are just some of the input items, and they're all going to make sense over the next week and a half. Now there's a thing called working capital, and we really haven't discussed working capital, but working capital is basically money that's necessary to run the business. And it's like you're not going to make money, you're not going to be able to depreciate it, which you don't know what depreciation is yet, but I would liken it to this. I own an olive farm, and every October, November, I pick my olives, and I need to pay the people that pick my olives, the crews that come into work. And so I need to have a certain amount of money available to pay my bills. Now, I don't sell all of my olive oil in December. I sell it over the next year. So I recover that investment over the next year. So basically, working capital is cash that's required to run the business. And so what we're going to assume here is that the cash required to run the business is 12% of the gross sales revenue forecasted for the next year. Now, gross sales is it's a forecast. So this is a number you might want to do some sensitivity tests on. Now, there's a little other verbiage in here you're going to want to read and understand. But primarily what we have here is that we have additional expenses associated with operating the facility are a little over $500,000 a year. They're going to increase at 3.5% per year over the life of the project. And so what I want from you is I want a complete after-tax cash flow analysis to determine if this is a good investment. Now, again, I said after tax, we're going to understand how to do taxes within the next week or two. And so the deliverables are going to be the basically described here. This is what's going to be required in your analytics, in your Excel spreadsheet. And then you're going to write a report. And while this may seem like a lot of detail, my purpose of this is when you get out into industry, you're going to be competing with a lot of people that are very smart. And what's going to separate you from your peers in industry are two things: your ability to speak and your ability to write. So I want you to write the report. This discusses everything in the report. I'm going to be discussing this throughout the rest of the quarter and adding to this page. But the most important thing in a report is going to be the executive summary. Most senior management do not have the time to read an entire report. So they're going to read an executive summary. It should never be more than 1 page. And the purpose of it is to highlight the important points in the report and attract attention to either read the rest of the report or have an analyst go through the report and report it back to senior management. So this executive summary is the most important document you're going to have in a report. And then the rest of this is all self-explanatory. The key thing here is I want to have the assessment of uncertainties and risks. And we're going to go over that over the next couple of weeks on how to do that. And so what do we have that's doable? Because you can read the rest of this in here, but November 10th, that should be November 17th. November 10th, we're going to have 3 worksheets covering revenue, expenses, and investments. And I'm going to go through these, and so I'm going to show you the PDFs of my worksheets. Then on November 17th, we're going to talk about depreciation. So that gives us almost a month to get, just 3.5 weeks to get through understanding how depreciation works. And then the final report and Excel file are going to be due Thursday of finals week. Now, not Thursday of finals week, Thursday of the 10th week. And that is the week after Thanksgiving. So I suspect there's going to be some work done during the week of Thanksgiving. So that's what we're going to have here. I want to show you, and we're going to talk about this a little bit more next week, but what I'm looking for primarily from the revenue sheet. So we're going to put together a workbook, and the way I like to do my workbooks is I have a page with inputs and results on it. That way I can change a number and see what my results look like. Now the revenue worksheet, where is the revenue going to come from? Well, the revenue is going to come from the sales and markup of oil, bunker oil you're purchasing. So depending upon your assumption, this is the sales volume of oil. This is what it costs. Initially it's $85 a barrel, and we're marking it up 4%. So our gross revenue, our gross sales, is going to be $176,800,000 the first year. And notice how I have, and I put this in the write-up, I have end of period, and I also tie it to a year, just to kind of a sanity check to make sure things work. And so you can liken this to the first week of class when we talked about accounting information. This is sales. This is income, revenue. And then we have various categories of expenses. And the expenses primarily are going to be the rent, the wharf rent. If you remember, it was $350,000 a year. Operating expenses, beginning at $525,000 a year. And the cost of goods sold. And that is, that's the cost of the oil. That is basically well, let's go to this sheet. It's basically this number right here, sales volume times cost of oil. Sales volume times cost of oil. So I'm going to cover just these two things. This is enough to get you started. You don't have to get this done. This is not due till November 10th. I just need an Excel spreadsheet to show that. And the purpose of these is I'm going to make this a portion of the grade. To have these, but this is just to make sure you're not doing everything over Thanksgiving. That you're. What I don't want is I don't want a flood of text messages or emails on Thanksgiving or the day after Thanksgiving asking questions on the project. I want you to be polishing up your write-up, not working on the model itself. So feel free to email me or text me questions about this, but this is going to get developed more and more over the next several weeks.